My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I want to describe how we are going to be using the Accounting for Income Taxes template. So the first thing that you'll want to do is go ahead and download and maybe even print out a copy of the template. That can be found in the content browser under the Chapter 16 module, and it's just the PDF file, Accounting for Income Taxes. And so I'm going to bring that up here and just talk a little bit about how we are going to go about using this to help you navigate your way through dealing with this accounting for income tax issue. All right, so the way that we're going to work these problems is we're going to start out with pre-tax GAAP income. So we will either be provided that information or provided a sufficient amount of data to determine our pre-tax GAAP income. Once we have that information, then we will either add or subtract any permanent differences. Remember, in the previous video, we talked about permanent differences that primarily consist of municipal bond interest income, certain types of expenses related to making those investments, life insurance proceeds from the passing of an executive, and then the related expenses and a few other things. So those are going to be permanent differences. Obviously, not every problem or not every entity has those permanent differences, but that's the first thing that we want to deal with. So we will have our pre-tax GAAP income. We will add back or subtract any of those permanent differences. So for example, if we have municipal bond income is included in our GAAP income statement and would be a subtraction here to arrive at what's called our adjusted pre-tax GAAP income. Effectively, what this spreadsheet or what this template is going to do is it provides us with a mechanism for reconciling our GAAP income statement with taxable income. That's what we are trying to do here. So we're going to start out with pre-tax GAAP income. If we have any of that municipal bond income or life insurance proceeds, for example, those would get subtracted because they are revenue or income items included in the GAAP income statement. They have to be excluded from our tax return. And then similarly, any sort of expenses related to those items that are classified as permanent differences, those will get added back. They may be legitimate expenses that appear on the GAAP income statement but are not deductible for tax purposes, and so they will get added back here. That gets us to what's known as, or what I'm referring to as, adjusted pre-tax GAAP income. And the adjusted pre-tax GAAP income is what determines or is the basis for determining our income tax expense. Not what we pay to the IRS, but the expense that is going to be recognized on the GAAP income statement. And the computation for our purposes is relatively straightforward. We take our adjusted pre-tax GAAP income, multiply it by the tax rate, 35 or 40% or whatever is specified in the problem, and that tells us what our income tax expense is going to be. Then we move on with our temporary differences. And our temporary differences, remember, are classified into two categories. They generate either what are known as deferred tax asset items or deferred tax liability items. The example that I used in the previous video was where we use maker's depreciation for depreciating an asset for tax purposes, but use straight line for GAAP purposes. In the early portion of the life of that asset, we will have more depreciation recognized for tax purposes than we would for GAAP purposes, and so that would result in a subtraction for a deferred tax liability item. The depreciation, the fact that there's maker's depreciation or accelerated depreciation for tax purposes and straight line depreciation for GAAP purposes, that results in a deferred tax liability. And how these temporary differences get classified. They get classified based on or in the year in which they are initiated, the year in which that difference originates. So in the year in which we purchase an asset, if we use maker's depreciation for tax and straight line depreciation for GAAP purposes, which is typical, that will generate a deferred tax liability, and we will have to keep track of that deferred tax liability until the asset is fully depreciated on both the GAAP income statement as well as the tax return. And so what's going to happen here, the way that we're going to be using this little template here, is we'll get to adjusted pre-tax GAAP income. That determines our income tax expense. And then we'll have items that we'll be adding or subtracting from GAAP income to arrive at our taxable income. And our taxable income is the basis for determining our income tax payable. The taxable income is what would actually appear on our tax return. We multiply that by the tax rate, and we will have income tax payable. And so we have income tax expense. That's a function of the GAAP income statement. Income tax payable, the actual liability, is based on taxable income. The difference between these two is going to be the result of one or more deferred tax asset or deferred tax liability items. For each item that we might have 2 or 3 deferred tax asset items. We might have 2, 3, 4 deferred tax liability items. For each one of those, we will create a separate deferred tax asset or deferred tax liability account, and that therefore will have a separate line item entry in a journal entry. So we'll have income tax expense, we know that's going to be debited, and income tax payable, we know that will get credited. And to the extent that there's a difference, those differences are going to be the result of deferred tax asset or deferred tax liability entries. And it may be a combination of 1, 2, 3, 4, 5, whatever number of deferred tax asset and deferred tax liability items are being created or being accounted for this particular year. So that's generically how we are going to be using this template. It's designed to be provide a guide for you to reconcile GAAP income to taxable income. That's going to be the driver for determining our recognition. This is essentially the measurement or valuation process, and we use this information to help us determine what our recognition is going to be. That's the journal entries. And then we use the journal entries once again to identify our balance sheet and, to a lesser extent, income statement disclosure. Once again, in this particular course, the emphasis is on the liability side of the balance sheet, but obviously there will be some income statement entries, for example, income tax expense, and there will also be some asset entries. Deferred tax assets will potentially be generating. But that's how we're going to be using this template. In future videos, we'll be demonstrating specific problems out of the textbook that will follow this process and demonstrate for you how to account for certain types of differences, permanent as well as temporary differences.